Hey, what's up, everyone? Welcome back to the channel. If you're into generating passive income, building long-term wealth, or chasing more cash flow from your portfolio, this one's for you. Today, we're zooming in on Canadian dividend stocks, which ones look like solid buys right now, which ones are red flags, and how you can build a stable dividend-paying portfolio with Canadian exposure. By the time we're done, I'll share my top 5 to 7 picks that I'm personally favoring. Spoiler, some of these are in my watch list. Now, quick note, this video is not financial advice. Always do your own research, and consult your tax pros. If you like content that's data-driven but still casual, hit that like button, subscribe, and ring that bell so you don't miss future deep dives. Let's dive in. Why Canadian dividend stocks? Alright, before jumping into names, I want to start with the why. Why do I believe Canadian dividend stocks deserve your attention, especially right now? The Canadian dividend landscape and what makes it unique. Sector tilt. When you look at Canada's stock markets, especially the TSX, the weights tilt heavily toward financials, energy, pipelines, utilities. That means you get natural exposure to sectors that tend to generate cash and often distribute dividends. For example, energy infrastructure, pipelines, utility regulation, those are assets where cash flows are more stable and predictable. Long dividend histories. Some Canadian firms essentially have a culture of paying and increasing dividends over many years. For instance, Enbridge has been increasing its dividend for decades. Yield advantage potential. In many cases, the dividend yields in Canada, for certain names, are higher, or comparable, to US names, especially after taking into account growth potential, risks, and the valuation. Currency diversification. If your base currency is USD, or any other. Owning Canadian equities gives you indirect currency diversification. You gain or lose depending on USD left and right arrow CAD moves. That's a double-edged sword, but it's a tool. Risks or headwinds unique to Canada that you must know. Before you get too bullish, let's acknowledge what can go wrong. Withholding taxes. Depending on your country, dividends from Canadian stocks may be taxed at source. Canada might withhold. For example, US investors generally face a 15% withholding tax on Canadian dividends unless abated by treaties. This eats into effective yield. Currency risk. Gains in Canadian dollars may be offset or amplified by fluctuations in CAD relative to your home currency. Commodity and regulatory exposure. Because many Canadian dividend companies are in energy, pipelines, natural resources, consumer risk and regulatory intervention matter. If oil crashes or regulations shift, your dividends may be at risk. Smaller market liquidity. Compared to US markets, Canadian markets can be less liquid for smaller names, meaning more volatility and slippage. Valuation traps. A super high yield might be a red flag, or maybe the company is distressed, or the dividend isn't sustainable. Why now might be a good time? Interest rates have been volatile, many investors are hunting yield again. Energy and infrastructure valuations have been under pressure in some quarters, creating potential entry points. Some Canadian names are being overlooked because US investors focus more south of the border, that may create mispricings. Inflation protection. Many pipelines or infrastructure contracts are linked to inflation or have built-in escalators. So, here's the deal, when I'm researching dividend stocks, Canadian or not, I don't just chase the highest yield. That's one of the biggest mistakes new investors make. A high yield looks sexy, 7%, 8%, maybe even 10%, but that number alone tells you nothing about how safe the dividend is. Let's go through the main metrics and filters I personally use when picking dividend stocks, the exact way Graham Stephan might break it down for his portfolio. Dividend yield, but not in isolation. A dividend yield is simply the annual dividend divided by the stock price. But here's the catch. If a company's stock price has crashed 40%, the yield will look artificially high because the denominator, price, is lower. That could mean the dividend's in danger. White heavy check mark my rule of thumb. Look for yields between 3% and 6% for most sectors. Below 3%, the payout might not be worth the opportunity cost. Above 6%, check if the company's cash flow actually covers it, otherwise it's a red flag. Example: Fortis Incorporated, FTS.TO, currently yields around 3.9%, not flashy, but that's backed by decades of increases and a stable regulated utility business. Meanwhile, Enbridge, ENB.TO, yields around 7.5%, which sounds high, but you've got to confirm if their cash flow and payout ratio support that. Think of this as how much of the company's profits go toward paying dividends. It's like someone making $5,000 a month and spending $4,800 on bills, not a lot of room for error, right? A healthy payout ratio for most companies is 40 to 70%. For utilities or pipelines, steady cash flow sectors, even 80 to 90% can be fine. If it's above 100%, that means the company is paying out more than it earns. That's not sustainable long term. White have a checkmark example. BCE Incorporated, BCE.TO, has a payout ratio that fluctuates between 85 to 90%, but because its cash flow is consistent and recession-resistant, telecom services, internet, etc., it's acceptable. Compare that to Whitecap Resources, WCP.TO, an oil and gas play, which can have a low payout ratio in good times but might spike over 100% when energy prices dip. That's risky. This is one area where Canadian stocks shine. Canada actually has an official list of dividend aristocrats. Companies that have increased their dividends for at least 5 consecutive years. In the US, it's 25 years. These companies have a culture of rewarding shareholders. It's a sign of disciplined management and strong balance sheets. White have a checkmark some notable names on that list. Fortis, FTS.TO, 50 consecutive years of increases. Enbridge, ENB.TO, 28 plus consecutive years. Canadian Utilities, CU.TO, 51 plus consecutive years, the longest streak in Canada. The longer the streak, the stronger the commitment to maintaining it, even in tough markets. Forget net income for a second. Dividends come from cash, not accounting profits. That's why I always look at free cash flow, FCF. A company with stable or growing FCF is one that can afford its dividends, reinvest in the business, and still have a cushion. Example: Enbridge generates billions in distributable cash flow, DCF, which comfortably covers its dividend and future growth projects. TELUS also focuses heavily on free cash flow growth, aiming for double-digit increases to sustain its rising payout. One of the silent killers of dividends is excessive debt. If interest rates rise or cash flow dips, the company might be forced to redirect dividend money toward debt repayment. White have a checkmark look at metrics like debt-to-equity ratio, interest coverage ratio, credit rating, S&P, Moody's, DBRS. Example: Fortis and BCE both carry large debt loads, but their cash flows are predictable and they operate in regulated sectors. In contrast, some high-yield REITs or oil companies carry excessive leverage that can threaten dividends when markets turn. A solid dividend stock can still be a bad buy if you overpay. I use simple valuation tools. P/E ratio, price to earnings. PCF, price to cash flow. Historical average comparisons. Yield versus historical yield. If the current yield is 20% above average, that might signal undervaluation, unless it's a trap. Example: If Enbridge's long-term average yield is 6.2% and it's now 7.5%, that may imply it's undervalued if fundamentals haven't worsened. Lastly, what's the company's moat? A strong dividend stock doesn't just pay consistently, it has a reason it can keep doing so. White have a checkmark ask: do they operate in a regulated or oligopoly market? Is their product essential, energy, communication, utilities? Do they have recurring revenues or subscription models? Canada's telecoms and utilities score high here, they're basically oligopolies. You have BCE, TELUS, and Rogers, three giants controlling most of the telecom market. It's tough for new entrants to disrupt that. Now that we've built our foundation, let's talk about the real meat of this video, my top Canadian dividend stocks to buy now and why. Top Canadian dividend stocks to buy now. Before we start, here's the mindset. I'm not listing these as hype picks. These are fundamentally strong companies I believe can deliver steady cash flow over the next decade, while providing exposure to Canada's most resilient sectors. We're talking about a mix of yield, safety, and long-term growth. Let's go one by one. Number 1. Enbridge Incorporated, TSX, ENB NYSE, ENB. Alright, let's start with the elephant in the room, Enbridge, the king of Canadian dividend stocks. What it does. Enbridge operates North America's largest pipeline network, transporting oil, natural gas, and renewable energy. Their system handles roughly 30% of North America's crude oil and 20% of its natural gas. That's insane. Dividend stats as of 2025. Dividend yield, ~7.5%. Dividend growth streak, 28 consecutive years. Payout ratio, around 65 to 70% of distributable cash flow. Dividend per share, annualized roughly $3.66. Why I like it? Enbridge has the holy trinity of dividend safety, predictable cash flow, long-term contracts, and inflation-linked revenues. Their pipeline network acts like a toll road. They earn fees regardless of oil prices. They've also been expanding into renewable natural gas and offshore wind, which future-proofs the business a bit. Risk. Debt load is high, over 80 billion Canadian dollars in long-term debt. So, interest rate spikes can pressure free cash flow. But management has been disciplined about refinancing and maintaining investment-grade credit ratings. White heavy check mark. Why buy now? The stock has underperformed the broader market recently, which pushed the yield to near 8%. That's a rare opportunity for long-term dividend investors. If you're building a core income portfolio, Enbridge deserves a top slot. Number 2. Fortis Incorporated, TSX, FTS NYSE, FTS. Fortis is like the poster child of stability. If Enbridge is the income engine, Fortis is the fortress. What it does. Fortis is a regulated utility company serving over 3 million customers across Canada, the US, and the Caribbean. They provide electricity and gas, essential services with predictable demand. Dividend stats. Yield, ~3.9%. 50 consecutive years of dividend increases, yes, 5 decades. Targeted annual dividend growth, for 6% through 2028. Why I like it? Their earnings are 99% regulated, meaning their profits are approved by regulators, providing stability. Even during recessions, people still pay for heat, light, and water. Risk. Fortis isn't exciting. Don't expect explosive growth. But for retirees or income-focused investors, that's exactly what you want: boring, predictable, and consistent. White heavy check mark. Why buy now? The market undervalues stability in high-rate environments. If rates start to ease in the next 12 to 18 months, utilities like Fortis will benefit from both capital appreciation and yield compression. Number 3. BCE Incorporated, TSX, BCE NYSE, BCE. Think of BCE as Canada's AT&T, a telecom giant that owns internet, mobile, and media assets. Dividend stats. Yield, ~8.3%. Dividend growth, 15 consecutive years. Payout ratio, ~85% of free cash flow. Why I like it? Telecoms are essential services, internet and mobile are now utilities. BCE generates predictable monthly revenue through subscriptions. Even with rising competition and capital costs, BCE's scale gives it pricing power. Plus, it owns Bell Media, which includes television and digital properties, adding diversification. Risk. Heavy capital expenditures for 5G rollout. slower growth in a high-interest environment. But BCE's high yield compensates for the slower upside. White heavy checkmark. Why buy now? This is one of the highest sustainable yields among large Canadian blue chips. If you're okay with slow growth but crave strong cash flow, BCE fits that niche perfectly. We've covered the first three dividend giants, Enbridge, Fortis, and BCE, the core pillars of a Canadian dividend portfolio. Next up, we'll break down TELUS, Pembina Pipeline, Power Corporation, and a few bonus names for diversification. Number 4. TELUS Corporation, TSX, TNYSE, TU. If BCE is the old-school telecom titan, TELUS is the younger, more innovative sibling that's quietly been evolving beyond traditional telecom. What it does. TELUS is one of the big three telecom providers in Canada, offering internet, mobile, and TV services. But where it's really differentiated itself is in its technology ventures, especially in healthcare and digital transformation. Dividend stats, as of 2025. Dividend yield, 6.2%. Dividend growth streak, 20+ consecutive years. Targeted dividend growth, 7 to 10% annually. Payout ratio, around 75% of free cash flow. Why I like it? TELUS has this unique edge in TELUS Health and TELUS Agriculture, two divisions that leverage digital technology to serve massive, underpenetrated markets. Healthcare digitization is a huge long-term trend, and TELUS Health already serves hospitals, clinics, and insurers across Canada. It's like owning a telecom and a tech company in one. Management has also been shareholder-friendly, committing to consistent dividend growth even through market volatility. Risk. Capital intensity. Telecom expansion and infrastructure cost billions. Plus, competition from BCE and Rogers remains strong. However, TELUS has been managing debt prudently and continues to expand market share in Western Canada. White heavy checkmark. Why buy now? TELUS shares have pulled back due to rising capital costs, pushing the yield to over 6%. If you're looking for a balance of income and modest growth, this is one of the most attractive telecom names in North America, not just Canada. Number 5. Pembina Pipeline Corporation, TSX, PPLNYSE, PBA. Let's talk pipelines again, because in Canada, energy infrastructure is the income goldmine. Pembina Pipeline isn't as large as Enbridge, but it's extremely well-run and shareholder-friendly. What it does. Pembina transports, processes, and stores oil and natural gas across Canada and parts of the US. Its contracts are long-term and often fee-based, meaning it earns money based on volume, not commodity prices. Dividend stats. Yield, 5.9%. Dividend growth, 10+ years. Payout ratio, 65% of adjusted cash flow from operations. Why I like it? Pembina's management has a track record of conservative growth and disciplined balance sheet management. Even during downturns in oil prices, Pembina maintained, and often grew, its dividend. They're also expanding into liquefied natural gas, LNG, exports and carbon capture, both of which align with future energy trends. Risk. Commodity exposure. While their contracts are fee-based, lower oil prices can still impact volumes indirectly. Regulatory risk. New pipeline projects in Canada often face political hurdles. White heavy checkmark. Why buy now? Pembina's yield is comfortably above 5%, backed by one of the best management teams in the midstream sector. If you already hold Enbridge, Pembina is the perfect complementary pick. It diversifies your pipeline exposure while maintaining steady cash flow. Number 6. Power Corporation of Canada, TSX, POW. Alright, let's step away from pipelines and utilities and move into financials. Power Corporation of Canada is like the quiet conglomerate that nobody talks about, but everyone owns indirectly through their ETFs or pension funds. What it does. Power Corp owns a majority stake in Great-West Lifeco, IGM Financial, and several other insurance and wealth management companies. It's essentially a financial empire, generating profits from life insurance, mutual funds, and investment management. Dividend stats. Yield, tilde 5.7%. Dividend growth streak, 10 plus years. Payout ratio, around 65%. Why I like it? Power Corp benefits from the stability of insurance and wealth management, two industries that generate consistent cash flows, even during recessions. Their exposure to multiple subsidiaries also reduces risk. When one segment underperforms, another often picks up the slack. They've also been investing in fintech and sustainable energy funds, quietly modernizing their portfolio. Risk. Slower growth. This is a steady, not flashy, compounder. Exposure to market cycles. If markets drop, wealth management revenues dip temporarily. White heavy checkmark. Why buy now? Power Corp is trading below its historical valuation multiples and yields nearly 6%. It's the kind of stock that doesn't move fast, but pays you handsomely to wait. For long-term investors seeking stability, it's a fantastic core holding. Number 7. Canadian Utilities Limited, TSX, CU. Now, if we're talking about dividend aristocrats, Canadian Utilities is the true royalty. They hold the longest consecutive dividend growth record in Canadian history, over 51 years straight. That's right, they've raised their dividend every single year for more than half a century. What it does? They provide electricity, natural gas, and energy infrastructure across Alberta and the northern US states. Dividend stats. Yield, tilde 5.5%. Dividend growth streak, 51 consecutive years. Payout ratio, around 75%. Why I like it? This is the ultimate sleep well at night stock. Regulated assets, predictable returns, and a conservative management team. Even when markets crashed in 2008 or 2020, Canadian Utilities just kept paying and growing their dividend. Risk. Growth is slow, and the company operates in a heavily regulated environment. But that's the price you pay for safety, and honestly, that's not a bad trade-off. White heavy checkmark. Why buy now? High yield, consistent increases, and a valuation that's near its long-term average make CU a rock-solid pick for dividend-focused portfolios. Number 8. Bank of Nova Scotia, TSX, BNS NYSE, BNS. You can't talk about Canadian dividend stocks without mentioning the banks, and Scotiabank is one of the most reliable income machines in the sector. What it does? It's one of Canada's Big Five banks, with a major presence not only domestically but across Latin America, Mexico, Peru, Chile, Colombia. That international diversification sets it apart from rivals like RBC or TD. Dividend stats. Yield, tilde 6.5%. Dividend growth streak, 11 years. Payout ratio, around 55%. Why I like it? Scotiabank has a strong balance sheet, robust profitability, and a long track record of stable dividends. Their international exposure provides higher growth potential than purely domestic peers, especially as Latin America's middle class continues to expand. Risk. Economic slowdowns in emerging markets could hurt earnings. And higher provisions for loan losses can impact short-term profits during recessions. White heavy checkmark. Why buy now? At a 6.5% yield and trading below its historical price-to-earnings ratio, Scotiabank looks undervalued relative to its fundamentals. If you believe in global economic recovery, this is one of the best high-yield blue chips in Canada today. Bonus pick, Open Text Corporation, TSX, OTEX Nasdaq, OTEX. Let's wrap up the stock picks with a wildcard, a tech dividend pair. Yep, that's rare in Canada, but OpenText is a legit one. What it does? OpenText provides enterprise software solutions. Think of it as the digital document and cloud automation backbone for large corporations. They operate in over 100 countries, serving Fortune 500 clients with mission-critical software. Dividend stats. Yield, tilde 2.4%. Dividend growth streak, 10 years. Payout ratio, around 35%. Why I like it? Scotiabank has a strong balance sheet, robust profitability, and a long track record of stable dividends. Their international exposure provides higher growth potential than purely domestic peers, especially as Latin America's middle class continues to expand. Risk: economic slowdowns in emerging markets could hurt earnings, and higher provisions for loan losses can impact short-term profits during recessions. White heavy checkmark. Why buy now? At a 6.5% yield and trading below its historical price-to-earnings ratio, Scotiabank looks undervalued relative to its fundamentals. If you believe in global economic recovery, this is one of the best high-yield blue chips in Canada today. Bonus pick: Open Text Corporation, TSX, OTEX, Nasdaq, OTEX. Let's wrap up the stock picks with a wildcard, a tech dividend pair. Yep, that's rare in Canada, but OpenText is a legit one. What it does: OpenText provides enterprise software solutions. Think of it as the digital document and cloud automation backbone for large corporations. They operate in over 100 countries, serving Fortune 500 clients with mission-critical software. Dividend stats: yield, 2.4%. Dividend growth streak, 10 years. Payout ratio, around 35%. Why I like it? This is a growth-oriented dividend stock. It won't blow you away with income, but it gives your portfolio exposure to tech while still contributing cash flow. Their consistent acquisitions and recurring revenue model create strong free cash flow to fund both dividends and expansion. Risk: high competition from US tech giants. Earnings can fluctuate due to integration costs from frequent acquisitions. White heavy checkmark. Why buy now? OpenText trades at a discount compared to US software peers and offers dividend growth potential, something that's rare in the tech space. If you want balance between income and innovation, this is a smart satellite position. At this point, we've covered the top 8 Canadian dividend stocks that combine yield, safety, and potential upside. Enbridge, ENB. Fortis, FTS. BCE, BCE. TELUS, T. Pembina Pipeline, PPL. Power Corporation, POW. Canadian Utilities, CU. Bank of Nova Scotia, BNS. Bonus, OpenText, OTEX. Next, we'll dive into how to build a portfolio with these names, what allocation strategies make sense, and how to reinvest dividends for maximum compounding.